Stock markets have erased most of the March losses and are now trading near February highs. But our next guest says that another correction could be imminent. Joining me now is Clem Chambers of InvestorsHub.com. Clem, welcome back to the show.
Thanks for having me on.
Clem, I want to draw attention to a few charts that you've published earlier a few weeks ago. And I want to show the viewers these charts too. So the first one is showing a dead cat bounce in the markets, which is where you are saying we're at now, and that another correction could come before a more substantial recovery could take place in the stock markets. Can you explain this a little bit more in detail?
Well, generally speaking, when the market crashes, you get a W wave. You very rarely get a V, and we've got a V. And as anybody that's been watching the news, the numbers, the economic numbers, are absolutely catastrophic. And yet we're back at all-time highs. So there's got to be a reason for that. And yes, there is a reason for that, but there's two. Obviously, the Fed has been pumping vast amounts of money into the economy. Same's been going on in Europe, same's been going on in Asia. So that is what is pushing up equities. But you've always got to ask yourself, is that all that it's taken? Well, not necessarily, because there's only so much you can levitate a market. What the market's actually telling us, if the market is sane, and it's always a bad idea to imagine that the market doesn't know what it's doing. If the market is sane, these current levels are telling us that there's a very large amount of inflation, that this liquidity that the central banks have created is baked into the market. So what we're seeing is not the market rising, but the value of money falling. Now, I'm not a gold fan. You've probably heard me on your site a few times saying, well, gold. However, this situation changes all that, because the situation is now, if the market is right, the only possible explanation for stocks being so high is that inflation is coming. And if you think about it, if inflation is coming, where do you put your money? A lot of people say gold, but they've only got small amounts of money to put away from inflation's grasp. If you are a billionaire, or if you are a fund, or if you are all sorts of different entities, there's only one place really to put your money to get out of the way of inflation, and that is equities. So I think what we're seeing is equities being very high because the central banks have basically baked in a 50%, maybe even 100% rise in inflation over the next 3 or 4 years. And this is the big money trying to protect itself from that inflation by going into equities, which by definition will rise with inflation, because sales rise, profits rise, the nominal value of their value in fiat rises, but actually the value of the money is going down. So that is a very clear, sane explanation for why equities are so high. Now, that will lift gold. It has to lift gold. So one of the things an investor can do is have their cake and eat it and actually buy gold stocks. And that's what I've been doing. Now, if you listen to the various pundits, they say, oh, there's going to be deflation. Well, there's probably is going to be some kinds of deflation. Right now, I understand if you want to buy a Lambo, you get about 30 or 40% off the value of that second-hand Lambo before COVID came along. So those sort of assets, yes, they will be going down in the short term. But in the medium term or long term, as a lot of people think of it, those assets will be actually going up in price because the value of money will be going down. So in the short term, if you believed in there being a move towards deflation, you'd hold some cash.
Okay.
Now, if you think there's some inflation coming, you'd hold some equities. If you think there's a lot of inflation coming, you go to gold. And you can move your portfolio between those three poles depending on how worried and how concerned and how much inflation you think is going to be coming. And that's what I'm doing. So spreading my money between cash, equities, and gold, and moving them depending on how sure I am that we are going to get big inflation, and how sure I might not be about that, and how I feel about deflation. I can move my money cheaply and quickly between those three poles, and that's my strategy going forward.
Okay, so Clem, you've brought up a lot of points, and we'll come back to address each one of those. But first, let's talk about your prediction of pricing and inflation. Now, a lot of market bulls would argue that the market really isn't pricing at inflation so much as it is pricing at economic growth, in that market bulls are already seeing a full recovery back to pre-COVID levels. And we're seeing some of the data support that, like employment numbers came in last week stronger than expected in the US. Shops are reopening all over the world. What do you say to that argument, Clem?
Well, I think they must be smoking very strong weed, because I don't care how strong you think the recovery is going to be. Unemployment levels are just massive. Yeah. In the UK,
Yeah.
one of the members of the Bank of England said this recession is going to be bigger than any recession since the beginning of the Industrial Revolution. Now, I'm sorry, it's going to take years to get back to where we were in January, not months or weeks. Yeah. So the market sees a year ahead. The economy is not going to be back to where it was in a year. So something else is driving these prices. We know what's driving these prices. It's the Fed liquidity. And the Fed and its proxies are basically pushing money into equities one way or the other. And they're doing it through basically squeezing out people from the bond market, and also by indirectly enabling certain parties to buy equities to support the market. Because if you're going to support the market and support liquidity and stop vicious circles, you've got to support property prices because that supports the middle classes. You've got to support equity prices and bond prices because that supports employment. It supports the workers, it supports the middle classes, and it supports the rich too. So that's what you've got to do, because if you have bonds go down and equities go down, you might end up in a vicious circle situation where you have an economic collapse. We have had an economic collapse. It's called employment, but they're propping up the rest of the economy by printing money, which is exactly what governments have done since the Roman Empire to actually solve a very, very sharp short-term problem by pumping money and in the end creating inflation. It's an old cure, and it always ends up in inflation. And that is one of the big reasons why the market is exactly so high. It's not just recovered a bit, it's recovered the whole way. And we haven't even had the second wave yet, and that's coming.
Clem, you've mentioned a potential second wave of the virus hitting. My first question is, when could that potentially take place? And my second question to that is that going to have any economic or substantial economic impact at all? Because I've heard arguments that even if a second wave were to hit, we may not see another global lockdown because governments simply don't want to do that again. How do you see it?
Well, first of all, the second wave is already upon the US.
Okay.
You can look at it. You can look at the numbers. The numbers have gone from 18,000 a day to 20,000 a day new cases. Yeah, America is relatively unlocked now. So you just have to look at the daily numbers to see whether it's coming or not.
Sorry, we're seeing thousands of people on the streets protesting. Clearly, they don't care about the virus. So, maybe they're just going to go out and consume nonetheless.
Well, yeah. Okay. Well, I mean, personally, I don't think there'll be another set of lockdowns. Yeah, because I don't think there's any country that can afford it. Because if they went for another lockdown of a month or two, that they're going to end up back in the Stone Age. Yeah. So I think you can see it in the media now. If you're in a war and you're going to lose that war or you can't win it, the strategy is to leave and declare victory. Right. Well, there's a little bit of that going on now. Nature had a review that said 3 million lives had been, according to the model's got various variables in it, 3 million lives have been saved. Declare victory and leave. Yeah. So, I expect there to be lots of declarations of victory over COVID and no more lockdowns. Yeah, because the impact of another 2 or 3 months of lockdown, like we've just had, would it's just incalculable. It's semi-incalculable now, right? Another couple of months of that or 3 months of that. I mean, it's unimaginable how bad that situation would be. So I don't think they're going to do that because they cannot afford to do it, because Western democracies can't afford it. The infrastructure of the taxation required to be extracted from the economies of America, of Europe, is so vast, you can't afford to break that. If they break that economic machine that funds their governance and their social systems, you kill the social systems, don't you? And I think that's dawned on them. They realise they just can't do it because the socialised system in Europe, for example, will just fall to pieces. There won't be the money for it. Now, what happens when countries can't raise tax money? They print it. You get inflation.
Yeah.
You could go to the Wikipedia page on hyperinflation and read the exact line. Countries, due to a shock that cannot raise money through taxation and can't cut their budgets because they are unwilling to or unable to, print money, and that drives inflation. That's almost word for word the classic definition of the causes of hyperinflation, and you can read it yourself on Wikipedia. And, not if, various countries will have to do that. They've kind of already done it.
Okay, so now you've talked about how bad the situation really is. Now, actually offline, you were saying the word bad really isn't doing the situation justice. Can you put into perspective for the audience really how bad the situation is compared to historical precedents? Is it as bad as 1929? Keep in mind that after the crash of 29, we saw a decade-long depression. And, that's 10 years. I mean, can we possibly see that now?
Well, look, the crash of 29 was not the cause for the depression of the 30s. The cause of the depression of the 30s were the bank failures that came after 1929. And you could say 1929 caused the bank failures of the early 1930s. And it was those bank failures that caused the depression. And, you've got a central bank system that won't let that sort of thing happen. It's the vicious circles that follow these crashes that the Fed are trying to make sure doesn't happen. And if they manage to do that, people, won't thank them for it because they won't know what they've missed. And, what they will have missed would have been something absolutely horrendous. And, anybody in the central bank would say, well, yeah, 10% inflation is terribly sorry about that. But we rescued the situation from economic meltdown. Yeah. And at the end of the day, 30, 40, 50% inflation over 4 or 5 years will make people sad. And most people won't even notice. Right. But from an investor's point of view, you had a pile of capital, you worked your whole life for it, and it just got cut in half. Yeah. And your pension, which you were looking forward to having, holidays in Hawaii, all of a sudden you've got a holiday down the local beach. Yeah. So even though rescuing the world by creating 50% inflation over 5 years doesn't seem so bad, for the individual, that could be a serious blow, right? And therefore, people have to look to protect themselves from that. And, as I said, I wasn't a gold fan a few months ago, but now I can only explain the height of the market by the fact the market is saying, well, there's 50% inflation baked in over the next 2 or 3 years. So with that in mind, people have to look to protect themselves from inflation. And, Kitco's customers know that. You're out of stock on gold. You're out of stock on silver.
Yeah.
I mean, why, that is the market talking, right? I mean, you don't go out of stock of those things because you can't get it in stock to sell more. You'd sell more if you could. You're out of stock of gold and silver because people feel it in their bones that this can happen. Well, the market is telling them they're probably not wrong.
So you say that you weren't a fan of gold before the crisis, but now you don't see any other option. Can you tell us about the other options besides gold that could potentially serve as a safe haven, and why you don't think those would stack up against gold in this situation?
Well, first of all, I think when there's an old joke which says, if you're not panicking, you don't understand the situation. Okay. When one sees bad things happening clearly, one should always wind back and kind of turn down the volume from the 10 that I've been on down to 6 and go quiet about it a little bit. Gold is good. It's quite difficult to invest in gold in any scale, right? $1 million in gold is a very difficult thing to buy. It's a very difficult thing to move. It's a very difficult thing to sell. It's a very difficult thing to store. I do not want £1 million or $1 million of gold in my basement. I really don't. Yeah. I don't want a piece of paper said delivered $1 million to this guy's house. I don't want that. Yeah. And I want to have an asset which I can sell easily and quickly and doesn't have a big bid off spread. That makes precious metals quite difficult. So my way of approaching it is to buy producing gold mines.
Okay.
So you've got the exposure on the equities, which will have an uplift if inflation is coming. And you've got the leverage of the mine makes a lot more profit per dollar of gold going up. Yeah. So you can have exposure to gold through an equity. So rather than buy physical gold, I've actually bought quite a large position in gold mines, a particular gold mine, which is actually, actually pays a decent dividend. So that is my approach to that. And I've also bought a fairly decent chunk of a silver mine. Because
Okay.
silver's the other one. If you believe the end of the world's coming tomorrow, you don't buy gold, you buy silver. Because you can't buy a chicken with a gold coin. It's too big. Yeah. But you can take an old American quarter and buy a chicken because it's silver and it's about a chicken's worth of silver. So, if you believe in the end of the world, it's all going to fall to pieces, you buy silver coinage. I think they call it junk silver in the US, but you buy old American silver quarters and dimes and that stuff. And that would be your stash. But if you don't believe that, like me, you just believe maybe 50%, maybe 100% inflation in the next 5 years, you want exposure on equities in precious metals. And that is my solution to that. The other thing is Bitcoin, because Bitcoin is digital gold. You can have $1 million of Bitcoin in your basement because it is in your basement, and you can sell it quickly, you can move it fast, and you can turn it back into fiat like that in small pieces.
Sure.
And you can even use it to buy with a credit card that's attached to it, so you can go in the store and buy a loaf of bread for $10 million with your Bitcoin. So that is another way of looking at precious metals or digital precious metals in this case. But equities is a strong place to be for precious metals. So that is my attitude towards it. And the other thing I've been putting money into is fine art, proper art. But most people, they can't buy a Gauguin. And that is the top end. But anything that's got long-term intrinsic value that has lasted the test of time is a place to put your money. But most people will want to be able to have it liquid. They don't want to buy a Ming vase because it takes 6 months to sell it.
Sure.
So there are issues depending on the sort of investor you are. But for the small investor, gold stocks, US-based gold stocks, I think is an area that they should really look closely at.
All right, Clem, we could talk about this all day, but unfortunately we ran out of time today. So thank you very much for coming on the show, and I appreciate your thoughts.
Thank you very much for having me.
Yeah, we'll talk to you again soon. Thank you for watching Kitco News, and stay tuned for much more.